All right, Fed terminal rate right here, 5.36%. This is down from about that 5.4 level that we recently hit. You could see that terminal rate really skyrocketed after that January data and February data. Here you can see the January hot jobs data and hot market data really started coming out, leading to the skyrocketing of expectations for rates going into the banking crisis. Banking crisis resets those expectations, and then we've slowly started trending back up to 5.36, which 5.36 is almost perfectly aligned with a rate of 5.25 to 5.5. Divide those two in half, add them together, divide them by 2, and what do you get? 5.375. So if this level matches 5.375, it means one more rate hike. If it goes above 5.375, it means potentially 2 more rate hikes. And under means potentially less than 1 more rate hike. And so as you can see, we're basically right there. And we've really skirted up in the past few weeks here to basically fully price in that next 25 BP. So I think these fears about another 25 BP, it's like, oh my gosh, we're going to get another 25. Nobody cares. It's already priced in. It's priced in, bro. Camera's right there. So then we've got our 5-year break even right here. As you can see, it's massively volatile. But what I really like to do is just zoom in over here on the right. And this is this uptrend I really want to get rid of. I'm tired of seeing this uptrend right here. This uptrend's gotta go. And as you can see, what we have here is still an uptrend. The uptrend is not going away. But it is finally starting to at least reject a little bit, which is good, because for a moment there, it just felt like we were just going to go straight up. So we're on this channel. It's clearly an upward trend channel. The Fed needs to pressure this down. The more this continues to rise, the more, in my opinion, we're going to start seeing a second rate hike potentially signaled by the Fed. I'm convinced, although they don't clearly say it, I'm convinced that this is pretty much all the Fed needs to look at, but that's too boring. But I mean, think about it. If there were one chart the Fed could look at to guide a monetary policy, I think it's this particular chart. If you want to see cuts, get that number to 1.6, kind of where we were the last time. We started seeing pauses and cuts from the Fed in 2018, ignoring the craziness of the pandemic here for a moment. Then the more we see this trend down, the more we could see a pause. And so as you can see, look at where the pause was. I wanted to write that here. The pause was almost at the bottom of this trend, right? If I place it right here, this is where we got pause in the middle of June. And so you can see, if we had our pause here, then clearly this actually doesn't even align with pause. This is sort of the hiking territory. You could almost make the argument that if we're in these boxes over here, you're in hike territory, and down here you're in pause territory, and then if you get lower, you're in the cut territory. So again, it's I like to call it the one chart that tells you exactly what the Federal Reserve is up to. I think this confuses folks though, because it's almost overly simplifying it. I mean, look, I was a big fan of saying I don't think the Fed's going to hike again in June because it would make the same mistakes of, well, basically what they did back in the 70s, where they hike and they stop, and then they hike again and they stop. I think all of that is nonsense. I think it's a bad idea. But looking at this chart, I look and I go, okay, well, crap. They're probably going to hike again because of the way the 5-year break even has moved. And that's okay. Things change. The data comes in strong, and then the Fed's got to keep doing their work. To some extent, though, it's not necessarily a terrible thing when we get strong data. This is where I still think it's kind of remarkable that people cheer this idea of, yeah, let's get really bad data because that'll make the Fed stop. No, give me strong data and then lay another hike on me. Who cares? Just give me good earnings at the companies that I invest in. That's what we're looking for. Obviously, we've got the earnings catalyst coming up now. That's going to be fun. But here, another way to look at this favorite Fed chart, which I think is so useful, is look at the 5-year for a moment. And what we'll do is we'll look at the, and I know it sounds a little confusing, it's the 5-year chart, like a view of the chart. of the 5-year break-even inflation rate. Okay, good. Now that we have that, here's what that actual chart looks like. So let me put this into context. Look at where the pause is. And here, let's make this a little smaller together so we could see this functionally and see where's that cut element again. Anyway, so you get pause. The pause level's right there. Hiking level is right here. And then where's cut and anything above that, obviously. And then where's cutting level? Well, cutting level is your Fed pivot level, I like to call it, which would be right about here. Pivot. And then we'll draw our little line over. We've done this many times before, but it's always worth reiterating just to compare where we need to be. There you go. That is roughly straight. There you go. So that shows you about that 1.6, 1.75-ish range, somewhere right around here. That's probably better right there. This is where we're trying to get to with the pivot level. So when you zoom in, it's obviously easier to view this. But again, I think this right here is a sign of success for the Fed. Whereas over here, you had a sign of panic. This was Q1 of 2022, and this was starting to feel like Paul Volcker. And people are like, Kevin, why did the stock market fall so terribly in 2022? Well, it's because of this single chart. One chart can tell you. And I know, look, I'm not a big fan of saying, oh, one data point is all you need, but that's literally what I'm saying in this. Is like, if somebody was blindly dropped into, if somebody was an alien and they were allowed to have one piece of data about what the Federal Reserve was doing, it could be literally this chart. Because that alien who would understand monetary policy, let's say, fiat and fake printed money. Anyway, let's assume they knew about that. They would argue the Fed would probably be pooping their pants in this range right here, which they did. Who remembers that December 2021 Fed meeting where we went through the minutes in January and we're like, oh my gosh, this is the worst report we've ever read from the Fed. It was all over here in panic time. This was panic mode. And that's why we had the stock market lows over here in mid-2022 and towards the end of 2022. It really wasn't until we had this confirmation of a downtrend over here-ish. I would probably say that last quarter to the beginning quarter over here, where in hindsight we start looking and saying, okay, maybe this Fed policy is actually working. Maybe we can actually anchor and keep inflation expectations anchored and not get Paul Volckered. And then, of course, we get, after our tax loss harvesting sales of 2022 in the stock market, you get your recoveries over here. Now it's just a matter of finishing the job, right? Finish the job, get this to continue to trend down, and it's somewhat flattened here. And so either waiting for those rates to bite or continuing to hike a bit more is what's going to drive that down into cut realm. My expectation, at least. So we'll see. But again, if I were looking at one thing, it'd be that. And it gives us a little bit of an insight into the latest from the Fed. Now, that also reiterates some of what the Federal Reserve is suggesting. And some of the speakers, we've had a lot of speakers this week from the Federal Reserve. I personally don't really care about all of the various different speakers. A lot of people, they send me messages. They're like, oh my gosh, there are going to be so many speakers from the Fed. That's going to tank the market. I'm like, no. You can almost expect what the Fed is going to say. And these are all various individual members just offering their opinion. Ultimately, the only opinion that really matters, and I know this sounds crazy to say, but it's J-Powell. When you get all of these other speakers, unfortunately, their opinions don't matter as much. What matters is the consensus of the Fed, and that's driven by J-Powell. So, look, I mean, just to catch you up, this is some of the stuff we're hearing. Fed officials say higher interest rates are needed to reach 2% inflation goal, and when you consider this, stacked up against this chart, yes, higher rates are needed to get that line down, of course. What do we have here? 3 Fed officials on Monday said policymakers will need to raise rates further this year to bring inflation back to the central bank's target. Still have Michael Barr here, who's the Federal Reserve Vice Chair for Supervision, told a bipartisan policy center meeting on Monday, quote, I would say we're close, but we still have a bit of work to do. A bit sort of implying 1 or 2 hikes. You've got a similar argument over here from Mary Daly, suggesting we likely need a couple more rate hikes to get to 2%. And here's another one where she says, in order to ensure that inflation is on a sustainable and timely path back to 2%, my view is that the funds rate will need to move up somewhat further from the current level and hold there for a while as we accumulate more information on how the economy is evolving. San Francisco's Fed chief says she is starting to see signs of the economy slowing, and added that supply and demand is coming into better balance. This is good. Of course, obviously, the risk is, again, going too far. BLS jobs data, of course, we saw well above the levels consistent with 2% inflation. That is the pay gains. Pay gains, remember, came in at 0.4%, which is annualized out to 4.8%. You know, what's funny is when I talk about annualizing, I talk about multiplying by 12. It's very simple. As soon as you start talking about annualizing numbers for Tesla, all the Tesla bulls start freaking out and going, you can't multiply by 12 to annualize. You have to compound the growth. No, look up the definition of annualizing. Oh my God. Anyway, so Raphael Bostic said that while the rate of inflation is too high, policymakers can be patient for now amid evidence of an economic slowdown, a stance at odds with many of his colleagues. So here you've got one of your doves. It's kind of like, I don't know, man, we should all pause. And then everybody else is like, bro, we only use one chart. Just look at the 5-year break even, man. It's still got to come down more. And then Bostic is like, but bro, you know, the economy's already slowing. Just wait and it'll come down. Look, the good thing is, and it's very actually good, inflation expectations are either, you could say, very anchored or trending down even more. There was a New York Fed inflation expectations piece that came out. And this is different from the University of Michigan survey. It's just another version of this. And Reuters published a piece on exactly that. Let's take a look at it. Americans said in June, okay, here we go. Come on, Reuters, with the ads. Oh my gosh. Okay, I'm going to give us huge ads here. Oh, that'd be a perfect place for me to remind you that on July 25th, we'll have a very large price increase for the courses on building your wealth. We are very, very excited to continue to deliver awesome content and fundamental research, investment ideas, and insights. So check those out. Linked down below, whether it's stocks or real estate, or property management, or making more money and getting stuff done faster featuring AI. Check out those links down below. So here you go, Reuters. Americans said in June they were expecting the weakest near-term inflation gains in just over 2 years, while continuing to mark up the expected path of home price increases. Yes. The New York Fed survey of consumer expectations for June saw inflation levels rising by 3.8% a year from now, and that is down from the 4.1 expectation in May. This is very good. You want to see anchored inflation expectations and downtrending expectations. This was the weakest read since April of 2021. That's fantastic. A 3 percentage point drop from the peak a year ago. So then you've got inflation outlook at longer horizons, however, was mixed. This would be your usually your 3 to 5 year outlook. Yep, 3-year holding steady at 3%, but rising to 3% 5 years out from the May 2.7 reading. Now, these levels tend to be relatively in flux, and this article is a little misleading in that inflation expectations here in the longer run are okay to technically sit at 3% and still have a 2% target. Usually you would expect inflation expectations slightly higher than what inflation is actually targeted at. I know that sounds weird, but the inflation expectation for about the 10 years prior to COVID were 2.8%. So the more we float around 2.8, you get a little bit above, a little bit below, the better. And we'd like to see that steady. Of course, if we can get them to trend down a little bit, that's where we start building in cuts. Now, it probably doesn't take or won't take much for this to rapidly fall in the event that something does break. And the way something could break, or the way to visualize something breaking, is just to zoom into the banking crisis. Because if you take this and you kind of just put something right here, like, oops, put a little oopsie-doopsie right here, you can see this plummet in inflation expectations can happen very, very quickly. And this is where you got banking failures really driving down fears or increasing fears that we're going to have substantial economic problems. So you get this sort of oopsie-doopsies. So anyway, this gives you a little catch up on inflation expectations and what some of the latest are. Again, we have been channeling up on these 5-year break-even inflation rates. Not to any kind of concerning level, but certainly a level at least that suggests, yeah, the Fed's probably got a little bit more to do. You could really see that here. That uptrend's really got to settle down and stop. So, it gives you some thoughts on inflation expectations. Again, good news from Reuters. Reasonable expectations here, mostly already priced in. Most of economic activity or market activity now should probably focus on, of course, I mean, inline expectations for CPI reports. But after that, it's just earnings, 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 earnings.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by